Good morning and welcome to the Shenkman Wealth Management Account Attorney Spring Webinar Series. This program is entitled The Gift of Qualified Small Business Stock, Section 1202. For those who don't know me, my name is Jonathan Shenkman. I'm a financial advisor, portfolio manager, and an accredited investment fiduciary. And as of last week, I'm also the president of my newly launched independent wealth management firm, Shenkman Wealth Management. After 15 years at major Wall Street firms, I'm excited to finally hang up my own shingle. I'll be sure to include my new contact information in the follow-up email to this webinar, and I welcome the opportunity to connect with everyone on this call. As I always mention, the goal of my program is to bring professionals together to help them better serve their clients. This is done by educating attendees on the latest topics in wealth planning and by encouraging collaboration between a client's attorney, CPA, and financial advisor where appropriate. My practice focuses on working with high net worth families, businesses, and not-for-profits. I manage individual investment portfolios, trust accounts, corporate retirement plans, and endowments to help my clients achieve their financial goals. In addition to the 25 or so events I run every year, I also do a fair amount of writing on the topics of investing and financial planning. You can read my work in Barron's, CNBC, Forbes, Kiplinger, the Wall Street Journal, the CPA Journal, Trust and Estates Magazine, and many other periodicals. After the program, I'll send out a link to all the publications where I publish my work. One quick note before I introduce our esteemed speaker, which is the handout to this program was sent out within the reminder email yesterday morning and this morning as well. Will also be sent out again in the follow-up email to this program tomorrow morning. Today, we're privileged to hear from Andrew Katzenberg, who is of counsel at DLA Piper based in New York, but serves clients nationally. Andy focuses on wealth transfer planning and preservation, multi-generational planning, estate and trust administration, nonprofit and tax-exempt organizations, charitable giving. Among his high net worth clients are hedge fund and private equity managers, business owners, art dealers, and athletes. He also represents clients in all phases of forming and managing nonprofit and tax-exempt organizations, including public charities, private foundations, and private operating foundations, and acquiring and retaining their tax-exempt status. Andy has authored numerous articles related to his field and is a frequent contributor to the New York State Bar Association's Trust and Estates Law section newsletter. Today, Andy will be speaking on the gift of qualified small business stock, section 1202. And with that introduction, I'll now turn the program over to Andy.
Thank you, Jonathan. I very much appreciate the kind words and for everything you do in the community as well. Thank you, everyone, for getting up this morning, to friends, colleagues, and clients. I think one of the great things about Jonathan's forum when it was in person is that we got to meet each other. The downside now being on Zoom, we might not be able to see each other in person, but we actually get a larger swath of people, whether in New York or across the country now. And I'm so happy to be able to present to you all on the benefits and the gift that is qualified small business stock, section 1202 of the Internal Revenue Code. Now, before I jump into actually qualified small business stock, for some of you, this may be, you already know it, but I think it's worth refreshing for about 5 minutes of just the general tax environment when it comes to trust and estate and tax planning, which leads us to how do we benefit or use or maximize what is qualified small business stock. So right now, the federal exemption has been increased to $12,060,000 per person for 2022, adjusted for inflation, or that is the inflationary adjustment. This will keep being adjusted till 2025, at which time, at the beginning of 2026, this is set to sunset back to the $5 million base, and which will also be adjusted for inflation. So right now, there's this kind of short window that you have this higher exemption limit to be able to maximize gifting and tax planning. One thing to note, the gift and estate exemptions are run parallel and are connected in the aggregate with each other. So if you this 12 million, call it exemption, either you can use it during life or at death or both. So don't be afraid, and it's always better to give sooner than later. Don't be afraid to use it up and nothing good with saving it. Actually, one update, I guess, on this is I put down that it's 15,000 calendar year for annual exclusion. It's actually 16,000 as of 2022 per person. And there is a 40% tax rate on anything that's above and beyond your annual exclusion and above the lifetime big exemption of $12 million. So these are, the construct you want to start with because they'll become very important when we're doing the planning. Then you have the state environment, which again is different than the federal. So there is a federal gift and estate tax, and then each state has their own, or not each state, a handful of states, New York and Connecticut being two of them, have their own estate tax. I think it's about 16 states that still have an estate tax and/or inheritance tax. The rest of the country does not. However, this is usually highly collected in the Mid-Atlantic Northeast, as well as on the West Coast, such as Washington State. Those are the places that have this. Now, for a lot of the people that are probably calling in, I would assume a lot are in the New York metro area. So that's why I'm kind of focusing, on the slide, just giving you some information regarding New York, Connecticut, and Jersey. New York's big thing is, their exemption is only roughly 6.1 million, again, adjusted for inflation, but there's a disconnect between the federal and the state. So you need to be aware of that. There's a thing called the cliff, which is if you go over your New York exemption by 5%, or it'll be 105% of that 6 million, which is roughly 6.4 million, you lose the entire exemption and you're taxed at $0 starting out. The big things to note, I think, really for New York are the exemption is not portable, so it's a use it or lose it. If you and your spouse don't plan correctly, you might lose some of that exemption. And then two, there is no gift tax in New York. So usually the workaround here is if you gift, during life, you can use up your big 12 million, and essentially New York won't charge you anything for it, and you can kind of maximize the dollars. Connecticut, same issue. Their exemption is not portable. It's a little higher right now, 9.1 million. And they're the only state in the country that has a gift tax, which is combined with their estate tax the same way the federal gift and estate tax works. So you have 9.1 million you can gift during life or at death. So if you have a resident in Connecticut, or you have someone that's coming from Connecticut or moving, you kind of have to do some playing with those numbers on when you're gifting and where you're considered domicile, take advantage of their exemption, or maybe a state that doesn't have a gift tax potentially. And New Jersey, they got rid of it. You always thought it might come back. They do have an inheritance tax. It has not come back. Probably as time goes, they will probably stay with no estate tax. It seems to be the case for the moment, but anything is possible, as we've learned when it comes to legislatures, whether state or federally. Now, got a nice little chart here. You guys can go take a look at that, at your delight, as an easy cheat sheet later on. But now I think now that we have a sense of, the general federal and state estate tax regimes, which allow us to make gifts, which then comes back to, what am I going to gift? What is a good asset to gift? One of those things could be qualified small business stock. And, that is a special type of stock. It's a stock that, that's a tax code term, why it's qualified small business stock. So you have stock, I have stock, it's just stock. If it meets certain requirements, it then falls under 1202 and may entitle you to an amazing income tax benefit. So I know I was talking all about estate tax, because that's, as a trust and estates attorney, that's where I start. But as things have shifted over time, income taxes have risen and have become just as difficult or piercing individuals as the estate tax. And as well, income tax, most clients like to recognize savings while they're alive, rather than it's nice to save for maybe your wife and your husband or your kids or your grandkids. But if you can take the benefit up front, you're more than happy to do that anytime you can. So what happened was in 1993, to encourage small business, again, that's a relative term. We're really not talking about the mom and pop shop on Main Street, but to encourage entrepreneurs in general, people who are creating ideas, to encourage them to raise money and encourage to get investments for those people. In 1993, they created Section 1202. They created this exemption for qualified small business stock on their gains. So in 1993, up into 2009, you were entitled, if you had what was known as qualified small business stock and you sold it and there was a capital gain. So again, this is all for the winners and not the losers. And as we know, the reality is usually you get, you hear about all the winners and don't hear about how many people this doesn't work for. But when you have a good product and it does well and you create a great idea, and let's just go with a very basic example. If you, sweat equity, you didn't really put $10,000 and create some idea that turns into $10 million. You were allowed on that $10 million, and let's say the date was 1995. You were allowed to take of that gain, which we'll call it 0 to 10, so it's 10 million of gain, 50% of that, you would be allowed to be exempt from capital gains. So if the capital gains rate, and again, let's call it 30% for federal. There's also the state. By the way, most states also have an exemption for qualified small business stock as well to piggyback the federal. So just say New York and the federal together would have been 35% on tax, and you have $10 million of gain. That means you would have owed $3.5 million of tax in the aggregate, state and federally. With this qualified small business stock, the 50% of that whole amount, so in 10 million, it would be 5. That 5 million of it, half of it, would not be subject to that 35% tax. Meaning instead of owing 3.5 million of tax, you'd actually only owe it would be $1.75 million of tax, meaning you just created or saved in tax arbitrage $1.75 million out of thin air, a legislative grace, we'll call it, again, for trying to better the marketplace and encourage these ideas. So that was so amazing about it. It then got vicked up in February 2009 to 75% of capital gains on qualified small business stock. And then in September 2010, it got moved up to 100% of qualified small business stock. So the timeline is and this is only for stock issued as of August 10th, 1993 and beyond. So if you have something for this, it wouldn't qualify as qualified small business stock. So if you have a company or a client that has stock that was between 93 issued and 2009, the beginning of 2009, you're entitled to 50% capital gain exclusion on the gains. If you have a client between 2009 and 2010, mid-year, around August or September, they'd be entitled to 75%. And if you're entitled, if you have someone after 2010, this is called 2011 for simplicity, they're entitled to 100% exemption on their capital gains. Now, it should be noted that this again was encouraged to incentivize growth, and this was under Republican presidents that these got put in, or at least the second batch got put in when we're talking about the 75 and the 100. The current Democratic legislature in Congress and president originally proposed to reduce that back down to 50%. And I guess it was the Build Back Better package. I forget, there were so many variations. But in the proposed legislation that came out last year, starting around September 2021, which never made it obviously through because of Sinema and Manchin in the Senate, that one of the clawbacks, we'll call it, to all these tax loopholes or tax benefits that they looked at for the rich, was pulling back qualified small business stock to a 50% exemption rate against capital gains, not the 75 or the 100. And this would have applied retroactively to all stock from 93 going to 2022 and forward. Didn't make it, but it's certainly something to be aware of as you go forward, because clients, it's definitely something that the Democrats, the left, will certainly keep targeting in the future. And if they can lower it, they'll lower it. Again, one of the reasons is it raises revenue. If you have only a 50% deduction against 10, they still get 1.75 million, of money to the federal government. So it's something that they didn't have before, which they can balance out somewhere else on the books. Now, though there's this, and again, let's just take the example that we're at 100% capital gain exemption. Not all capital gains are exempt. There is a limit. It's not an unlimited exemption. And if you have qualified small business stock, you are just paying zero tax. The exclusion is limited to the greater of 10 million or 10 times the basis of the stock. Now, normally you're rarely going to see, in truth, especially with some kind of founder stock, because someone puts not a lot in and they kind of grow it themselves with, an idea that they had. And the basis in these companies is normally very, very low on the original issuance of stock. So usually you're looking at a $10 million, exemption limitation. So again, going back to the example of someone in 2010 or 2011, no matter how, if they have a $100 million company, the first $10 million would be 100% excluded from the state and federal tax, meaning they would save roughly $5 million of tax. The balance, whether it's 90 million or 50 million or another 10 million, that'd be subject to the regular tax. Nothing there. Certainly, there are some fact pattern variations that you can read more about, like where you could find this 10% basis, that where someone would actually have a basis large enough that could then supplant, which means, again, they need to have a basis over $1 million to then exceed the 10 million sticking point. So it could happen, but it's few and far between in truth. Now, so those are the exemptions, but then you still have to qualify as qualified small business stock. And those requirements, are important, because if you don't qualify, then all this exemption, all this income tax benefit that we're talking about is not for you. You're just not entitled to it. So what are the simple requirements? One, you must be a C corporation. So if you have an S corp, an LLC, a partnership, sole proprietorship, some LTD technically, a foreign entity, again, these are domestic, by the way, it's only domestic, not foreign companies, you do not qualify. If you have clients, so when your first client comes and asks about, oh, do I have qualified small business stock? And they first answer is it a C corporation? And they might be confused, so you might want to always confirm this with your accountant, who ultimately, by the way, this is usually the accounting firms are the ones you have make that opinion letter to confirm this qualifies as qualified small business stock. You may also be able to get a law firm to do that in the tax department. Those are the two groups who would essentially certify for you when you decide that this is your planning or this is what you think you're going to do come, on your 1041 day to do this. You want to ask, is this a C corp? And when you want to ask their accountant, because clients sometimes forget between an S and a C because they just hear the corp and they see the ink and they don't know the difference. In truth, you want to confirm, make sure that, yes, this really is a C corp and not an S corp. If it's an S corp, it fails. It doesn't work. So we have a C corp. Then you can have no more than $50 million of assets at inception or at really issuance of the stock. The stock is considered small business stock when there is no more than $50 million of assets in the company. Again, this is for the small guys. That means we're not looking to just hand this out to every company out there. There's a limitation. Otherwise, it would just be, qualified business stock, not small business stock. We'll call it the third prong is that 80% of the assets must be in a qualified trade or business. And we'll get to that in a minute on what that means. Again, you actually have to be using it. You can't just be hoarding the money and not using it and then kind of creating some kind of vehicle that then you could take, 50 or 75 or 100% capital gain exclusion on $10 million. That isn't the point of this. We want active trades of business. We are trying to encourage, entrepreneurship. It was the idea of, again, putting this out there. Now, as we already said, the stock has to have been issued after August 10th, 1993. Again, client says, I got this company from 1975. It's not going to work. I have a company from 1990. Not going to work. It has to be after August 93 for it to be applicable to them. And then the last is the stock must be held for 5 years or more than 5 years. So 5 years in 1 day is the threshold. Again, if you don't hold it for more than that period, it's technically not qualified small business stock. After 1 year, you're at capital gains. But if you're selling year 3, it wouldn't count. So that's also something to be aware of when even considering, as we talk about maybe, I'm going to sell my company. If you're at year 4, you're not looking to sell unless there is again, I don't want to always say, don't let the tax dog wag the tail here. But you want to make sure if you're going to sell your company that it better be the right time. If you think there's an opportunity to wait another 6 months or 8 months or a year or 3 years, in that matter of fact, and it's just going to be bigger, so you can save $3.5 million. That's a big deal, especially if you go with something that's even smaller. Let's go with somebody who has 10 million is the value. Well, if you're saying, I'm afraid I might lose on a $10 million company, if I wait another year, it might be 8. Well, you're going to net more if you wait one more year at 8 million than you would at 10 with a $3.5 million tax associated. So you want to make sure that's the right timing and that makes sense. But again, if you have a $100 million deal on the table and you're afraid it might be 60 next year, the tax consideration is secondary to becoming rich first and then saving money second. Now, I mentioned the qualified trader business and what that is. And that's something that you often see where you get someone, there are some variations, we won't go into it when it comes to are you not? And again, you'd go to, this is where the opinion letter of a CPA or the accounting firm, I don't want to say singular CPA, a law firm or accounting firm is going to confirm for you, you are a qualified small business stock so that you can then, start planning around this. And again, the things that are excluded are those who are performing professional services. That's law, that's health, that's accounting. Those are just some. If you're doing professional services, you do not have qualified small business stock. Doesn't work. If you're doing banking or investing, that is not qualified small business stock. Farming, they are excluded. I haven't looked nearly too hard on that one. My guess is because there's so many other tax breaks for the farming industry, and this was just not one. This was not the intent. This is for entrepreneurs who are creating something to give to the public or sell it to the public. And then hotels and restaurants also excluded from qualified small business stock as a qualified trader business. And then you have, okay, what about if I transfer my asset in some sort of exchange? Does the person who gets it, is it still qualified small business stock for them? Because the issuance has to be, when there's under 50 million. Maybe when you make a transfer to somebody, the company's already worth $100 million. About the assets are over 100 million. Is it still qualified small business stock? Is it not? So the answer to that is, if there's a tax-free exchange, you normally essentially get tolling and tacking of whoever you go into the shoes of whoever the transferor was as the transferee. So you are in their same position. So the two places you're going to see this is if you make a gift to a trust, for example. The trust takes the same shoes that you were in and it has the same holding period. So if you were at year 4, they're taking year 4. Year 10, they're taking year 10. And it's still good. It doesn't matter how much the stock was worth when it got transferred to you, it's still qualified small business stock. Another one is if there's a reorg, you get a company that comes in and who's going to, buy you out and you're going to some kind of merge or get maybe stock or some variation, that too can be considered the new stock. Would also be considered on the reorg qualified small business stock. You are capped though at the value as of the date of that reorg or that merger, that sale date. So if you make a deal with a company and you sell it for $10 million, this is going to make it real simple to bring into the complex, $5 million. If you sell it for $5 million, what you have is that's your cap that's the exemption you can use against whether it's the 50, 75, 100%. If in 10 years after that deal, the stock that you received is now worth 20 million and you sell it, you have 20 million of gain, well, you're not entitled up to the 10 million at that point. You go back to the date of the original reorg and say, well, it was only worth 5 at that time, and that's your new ceiling. So just be aware of that when you're doing that. Now, where can we kind of maximize this? And because we've kind of said, this is the requirements. This is what you get with those, what kind of exemption you get. You're left at 10 million and that's great. And one bite of the apple is nice, but pigs get fat and sometimes hogs don't get slaughtered in this example. So when it comes to planning, and this is where you want to connect the qualified small business stock with the estate exemption and merge them together. You're just thinking, hey, I only have 10 million of exemption and this thing's worth 10 million. So what's the big deal that, that it's going up, or so what, it only gets so much of it. So I'm limited. Well, not quite. So first off, each taxpayer is entitled to the exclusion. So each taxpayer means, example I have with a client, if the father has some of the stock and his daughter has some of the stock, each of them is entitled to up to a $10 million exemption, and whatever the percentage may be. So they're able to maybe double or triple it depending on who's there. And again, if you have multiple business partners, each business partner is entitled to that $10 million exemption on their own tax return. And just to point out where it's found, it's going to be, I think if I'm correct, it's Schedule D is where you're going to place it and point out, I have 10 million and I'm exempt from it, disclosing to the IRS that I get it. And if they want to fight you about this stuff, they will. The second big piece, and I think this is one of, I would say this is probably the most contentious thing that's on here, number 4 being the second. Does a spouse, because I said each taxpayer is entitled, does a spouse get their own $5 million or $10 million exemption? The answer in reality, again, with a grain of salt, is no, they do not. A spouse is considered the same taxpayer. That's the position that you want to take. You do not want to articulate a different position, because the only thing that's going to happen there is your client's going to either be thrilled to death, which just sounds nice, or they're going to sue you and you're going to be for malpractice when the IRS comes to them for blood. The reason for this is in the code, it says in 1202, it says if you have a split return, if you and your spouse file separately, each of you is entitled to a $5 million exemption limitation rather than a $10 million limitation. So if you separate your return, you don't each get 10, you each get 5. However, the inverse is not true. There is no statement explicitly saying when you file jointly, you are only entitled to a $10 million exemption. It's just silent. There's the inference is, well, obviously, if you were to split it, it's now limited to 5 and 5. So if I went back to being joint, why would that be all of a sudden considered different? And I'd be allowed to 20 when I file jointly, but only 10 when I file separately. The logic wouldn't make much sense. So that's where a lot of commentators come out that's why you don't go that way. Now, the other side of the coin is people say, well, again, it doesn't explicitly say that. And if you are very academic, and if you look out, there's an article out there on tax notes that's kind of, I would say, we'll call the preeminent article written that really goes into this subject, and this is in general qualified small business stock. That talks about this issue, and it's very academic on what the commentary and the legislature said when they put it in, and comparing this to several other statutes that allow when that in one way when it's split, it's only one number, but when you do it jointly, you can actually take 2 numbers, and how that was interpreted, and maybe this will be interpreted the same way. Now, first off, there isn't really any case law or rulings or anything on qualified small business stock. You're not going to find it. So again, you're shooting in the dark when you do this. But when it goes back to that, potential being aggressive, and I've certainly heard people try to make the case or say it, and that's fine and dandy. Again, I'm not one to tell my client to go walk to the edge of the cliff and see if they fall or not. That's just not, I don't think that's a good way to be a tax practitioner. But the authors of this article that kind of bring up this issue that people kind of would argue that's what you rely on, there's 4 of them. I can tell you that one of the authors did not actually agree with the opinion, but was outvoted by the majority of the authors. So that's why it's in the article. Another one of the authors who admittedly now says, even though it's written there, she will not actually do this. And if someone comes to her, she will refer them to go somewhere else. And she is not going to write a tax opinion to support doubling up a spouse's 10 million exemption. Another author the third author I've spoken to, who isn't a tax attorney or a trust and estates attorney, so he's not the one doing it, he's just advising. He's admitted he hasn't actually seen someone do it or doesn't advise people doing it at the end of the day because of its risk. So at the end of the day, the people who actually propose the idea or say that it's possible, they actually don't do it themselves. So that should be telling in its own of where you want to fall. Again, going back to separate taxpayers are each entitled. So separate taxpayers are, besides the spouse, are any relatives of yours. There's no limitation there. And non-grantor trusts. And with my final, we'll call it 3 minutes, please stay with me because this is probably very important for you to hear. There's a with non-grantor trust, you're allowed to do what is known, is called stacking, that you're able to create multiple trusts. And each trust, if it's a non-grantor trust and qualifies, will be considered a separate taxpayer. And each of those trusts, therefore, is entitled to a $10 million exemption. So you and your wife are allowed a $10 million exemption together. Trust 1 that you created is entitled to $10 million. Trust 2, trust 3, trust 4. You can keep doing this. Now, there's a point of practicality where this won't be capable because you just won't have people, beneficiaries to stick there for this to work, because you're not just giving the money to me or you or your friends. You want it to be within the family, usually with this kind of stuff. But again, you're able to, I've been able to successfully stack 10 times with variations of in-laws and sisters and cousins and brothers and parents of the original people. Now, of course, that sounds so great. That way I can just multiply. I have 5 children. I can just multiply this unlimited with an unlimited swath. But there's some exceptions. 643F essentially is an anti-abuse code section that if you have identical trusts for this purpose, they will be viewed as one. They will not be viewed as separate independent taxpayer. They will merge them together if they're essentially the same. And what's required there is they can't be identical. And when it says it can't be identical, what it's really focusing on is the grantors and the beneficiaries and tax avoidance. So those are the 3 prongs there. So again, if you're going to do stacking, you probably might have the same grantor, but if you have a different grantor with different primary beneficiaries, and that's the big thing, primary, maybe not contingent, primary would entitle you to stacking. So what that would be is if you have a wife and 3 children, you could create potentially, now granted, when you have a spouse on a trust, it's almost not impossible, but very difficult to make a non-grantor trust. So let's remove the spouse scenario, but possible. The 3 kids, if you set up 3 trusts, 1 for each of your kids, those are the primary beneficiary, and everything else is identical in those trusts, but for the primary beneficiary being kid 1, kid 2, kid 3, each of those trusts would be allowed its own and separate $10 million exemption, which again, all comes back to you have that $12 million exemption. You have qualified small business stock that you probably can get valued fairly low when you're doing it before a sales event. And what you're able to do is say, I'm going to hand $2 million, let's just call it $2 million of valued stock to trust 1, trust 2, trust 3. You know what? Maybe my kids are over 18 years old and I'm comfortable with them and they're smart enough. And I'm going to give them each of them $2 million as well, directly of qualified small business stock. Well, then me and my wife would have 10 million we could get. Each trust would have 10 million and each kid would have 10 million. So all of a sudden I've created 70 million of possible exemption. Now, each of those buckets of stock is, subject to the 10 million mark. So if the stock that's 2 million only goes to 8, well then, I've saved 8 and 2 million maybe was left on the table because I kept too much for myself. That's okay. It's still a win. Just a magnitude of how well you are doing. So again, if you have, those folks, you want to figure out, what do you think this is going to be worth? Figure out the right number and kind of figure out a number probably a little over what you think it would be to make sure you maximize to the top dollar, that you get whatever that stock you put in there, that you assume when there's a sale event, this is going to be worth 10 million. So I max out the dollars that I can get tax savings rather than keeping it for myself and ultimately not being able to take advantage of that and paying a little more tax or a lot more tax potentially to the federal and the state governments. So I think I've run over by a few minutes. I don't want to keep all you from your 9 o'clock or 9:30 meetings. I appreciate the time. And Jonathan, I appreciate the forum.
Great. Thank you so much, Andy. If anyone has any specific questions, new business opportunities, or any other issues they'd like to discuss, please feel free to reach out directly to Andy or myself where appropriate. I'll be sure to include his contact information in the follow-up email to this program. As I mentioned at the onset, the goal of these programs is to stay up to date on timely wealth management related topics and to collaborate where appropriate. I think we can all agree that the clients who are best prepared are the ones who are served by a team of knowledgeable advisors. 3 more quick items before I let you go. First, the start of my summer webinar series is June 2nd. My first program is entitled Social Security Benefits for Spouses, featuring the Social Security maven and nationally recognized speaker, Peter Weinbaum. Second, please take 30 seconds to fill out my survey at the end of this program. If helps me improve my webinars and provide timely and interesting content to attendees. I thank you in advance. Finally, if you'd like to be kept abreast of my latest articles, webinars, and all the other work I put out, you can sign up for my monthly newsletter. Simply email me with the word newsletter in the subject line. And with that, this concludes today's session. Please stay safe, healthy, and have a wonderful day, everybody.